This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 90 was recorded on January 27th, 2020. I'm Eric Townsend. All-star Juliette Declercq, founder of JDI Research, is back with us this week. This episode of Macro Voices All-Stars is brought to you by TopTradersUnplugged.com, the leading podcast when it comes to quant and rules-based investing. I'll tell you how to claim a free copy of their new guide to the best investing books ever written at the end of this episode. Juliette, Happy New Year. It's great to have you back. We left you in mid-December, cautiously bullish on stocks, but warning that the cyclical uptilt that you had forecasted since August was getting kind of long in the tooth. Where do we stand now?
Hey, Eric. So in 2020, we already had World War III, and now a global pandemic is upon us. But it is still time indeed, 3 days left, in fact, to wish you and, of course, all your listeners a happy and prosperous new year. To get back to JDI Research Outlook, our optimistic Q4 2019 outlook, and you notice here that I'm not saying our optimistic 2020 outlook, relied on fair asset valuations, ample liquidity provision by global central banks, and a stabilization in global activity. Inventories had indeed hit really depressed levels on the manufacturing side in August, and that is a telltale sign offering hope of stabilization. From there, we had decreasing pessimism chased by rising optimism, which overtook as an asset driver, while global geopolitical tensions generally decreased. I think we can say fairly that early last week, the global consensus was still that robust global consumption and investment would subsequently flourish thanks to powerful wealth effects and lower borrowing costs. I like to position ourselves versus consensus to ensure mask risk-reward in our recommendation. So what I wrote to client in mid-January is that the granularity of the manufacturing PMIs already highlighted a possible top in the recovery and what I'd call L-shaped, e.g. stabilization, rather than the V-shaped recovery that was already discounted by markets. For example, stocks of finished goods levels were already back to the average of the business cycle, according to PMIs, and that obviously removes one important tailwind from the manufacturing outlook in 2020. What was also very striking is that optimism was centered on China. Of the 14 markets reporting improved manufacturing conditions as part of the global PMI, 8 were located in the Asia-Pacific region, with one of those obviously being China. This is particularly important given this is also where sentiment will be hit the most by the coronavirus. This was a concern, not only because the Chinese PMI leading indicator, e.g. new orders versus inventories, plunged in January, but also because the money and credit impulse, which I use as a 6 months leading indicator, has peaked 6 months ago and is actually back to zero this month, meaning neutral for future activity. Also, I actually expect that it will turn negative going forward. It leads China cycle by an average of 6 months, which means that we are right in the sweet spot for activity in January, but that it is whole downhill from here. Not, of course, that China's credit leverage is the most important leading indicator for global growth and inflation. So it should be no surprise that my main recommendation this year, and way before the outbreak of the virus, has been long US Treasuries and short inflation break-evens. And we have actually warned against chasing oil, copper, or emerging markets higher.
Juliette, those are very interesting thoughts about manufacturing. But if I remember correctly, you pointed out, going back to last August, that the global cycle was now driven more by services. So should we ignore the stagnation in manufacturing?
Great question, Eric. So, for the services sector, which should really react like clockwork to much easier financial conditions this year, the most recent surveys were more encouraging, with the leading indicators actually pointing to rosier activity conditions. My concern for the services sector is that corporates do not appear to be buying into the Fed-induced sugar high, and the PMI's business expectations component are actually very strongly lagging the euphoria that you would expect, considering much easier financial conditions. I've analyzed the situation and I see two main reasons for this. Firstly, obviously, the Fed can print money, but it cannot print workers. And that means its ability to counter the ongoing slowdown is actually diminishing. And I see trend growth in H1 this year around 1%. And secondly, and this is really key, banks are also seeing through the easing in financial conditions. I've produced a full analysis of the G4 bank lending survey in my last JDI research report. And you can actually observe a broad tightening of credit standards in G4. It's actually much worse in EM. And that is despite low rates and especially for lending to corporates. Meanwhile, loan demand is also collapsing. Now, don't get me wrong, this doesn't mean that a credit crunch is upon us and a recession is around the corner. However, those are trends that are really worth keeping on the radar because credit supply is the very channel by which the Fed's liquidity feeds through the real economy. So the bottom line is simply that there is a rapidly fading link between financial conditions and reality. We also have to be conscious that analysis of past correlations, and I think a lot of macro pundits are making the mistake of looking at what's happening today macro-wise in relation to whatever happened in the past. And I think really we have to consider today as like something completely different. And that's another reason why basically financial conditions and credit are not really linked anymore. And this means that we cannot use it as an accurate guide for future trends. So the worries of the developed world having hit the liquidity trap has never been so justified.
Juliette, something I want to give you credit for is you have correctly predicted that over time, the Fed's ability to impact the real economy with their balance sheet machinations would decline, and that's exactly what's happened. So now that it has, just as you predicted, become less effective, what conclusion does that lead you to with respect to asset prices?
So, in my opinion, what we are going to see is a continued soft landing, which basically anchors the low interest regime through demand deceleration. And it's actually the lack of uncertainty about the outlook which underpins defensive asset value. The hallmark of this business cycle is the loss of money velocity, with central banks' liquidity being diverted to financial assets rather than credit flows to the real economy. And this is actually likely to accelerate because there's nothing else that central banks, and particularly the Fed, is actually considering. And that's what explains the dichotomy between financial asset inflation and goods inflation. And for me, this is the main and ongoing macro theme in my mind. And it's that central banks' impotence is what is actually fueling the everything bubble. In a way, I see asset prices, and especially US asset prices, which are much more defensive, being able to discount before the Fed even gets there that US rates are going to zero. And this is really what fuels the asset bubble. And I don't really see the Chinese virus stopping this really entrenched dynamic.
Juliette, you mentioned the Chinese, what has now become known as the 2019 NCOV coronavirus. We can't finish the interview without getting your perspective on how that's going to affect this entire story.
Yeah, of course. So firstly, I'd like to highlight that I'm obviously not a virus expert, but I've spent all weekend and all last week reading everything about it. But what I think is that the impact of the pandemic on markets would be nowhere as important as the capitulation we've seen today, for example, in emerging markets, if the fundamentals were truly solid. So it's not luck or medical expertise that allows our 2020 recommendations to be quite profitable this month. It is actually a focus on the macroeconomic underlying trends rather than noise, greed, or fear. And I think that's really something that listeners should be really focusing on. To get back to the virus, of course, it complicates the macro matter as it increases once again downside tail risk for global activity. So having spent the whole weekend researching facts, I think we can say that it's spreading fast and it's led Chinese President Xi to call the situation grave. It looks like more than 2,700 people are now reported to have contracted the virus and more than 20,000 are under observation. I think 80 people are known to have died, and Chinese authorities now believe that carriers are contagious before symptoms actually appear. This has been a source of concerns because SARS, the 2003 SARS, was quickly contained thanks to carriers being only contagious after symptoms appeared, which made it much easier to isolate the diseased. However, the virus appears to be more contagious than SARS, but also less dangerous. And this is really a key thing. It is often the case that contagiousness is inversely proportional to the dangerousness of the virus, simply because milder symptoms allow the disease to spread more easily. Basically, if you're dead, you're not passing the virus to anyone. And this is what seems to be happening so far. So all the external cases that we've had are actually quite mild. So the 3 persons infected in France are well, and I believe that the US case is the same. Moreover, I think a very large majority of deaths have occurred for those with pre-existing health condition, which is basically the same as for the seasonal flu. I think in its current form, the virus is not meaningfully more dangerous than the seasonal flu. So it's a bit more contagious, but not much more dangerous. And basically, a doctor's best advice would be to catch it before hospitals are swamped so that you can receive decent care and basically become immune. To go back to markets, as you know, my belief is that the potential cyclical up tilt has been overhyped after recession fears took over markets in August. So I would continue to avoid cyclicals and emerging markets. And I would also continue recommending defensive equity portfolio via long US equities and defensive. I also recommend long dollar versus risk FX and commodities and short versus yen and gold. There's no question that the fragile Chinese economy and EM will be hit hardest through a further hit on sentiment. However, I really think that the Western world should be spared. And, 1,000 die of seasonal flu every year without impacting markets. So I'd really look at this dip as an opportunity to pick up to keep trading the same outlook that I've been highlighting for the past 2 months now, and look for opportunity to pick up defensive stocks. And I like particularly the US.
Is it time to buy the dip already, or is this something we need to wait out and see how this virus develops?
Look, I think it depends on everybody's risk management, but I would start to buy the dip here, yes, because I think there was much more fear of positioning than actual positioning according to the metrics I look at, especially in equities.
Well, Juliette, we can't thank you enough for another terrific interview. We look forward to getting you back in a month or so for another update. This episode of Macro Voices All-Stars was made possible by TopTradersUnplugged.com, the leading podcast on quant and rules-based investing. Be sure to claim your free copy of their recently updated guide to the best investing books ever written at TopTradersUnplugged.com/macro guide. And if you haven't heard it yet, be sure to check out my full-length interview with Niels Kastrup-Larsen on trend-following strategies, which is linked in your Research Roundup email. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.